Bu
Oke.
Yana?
Oke.
Oke.
Ya, Bu Diana.
Iya,
Kuat.
Ya, Bu Diana. Ini waktunya sudah hampir jam 9. Mungkin bisa dimulai saja, Bu Diana.
silakan
Baik.
Ibu.
Silakan kepada Mbak Tiani untuk memulai acara.
Assalamualaikum warahmatullahi wabarakatuh. Om Swastiastu,
Waalaikumsalam.
Namo Buddhaya, greetings of virtue. Good morning, ladies and gentlemen. Let us pray to Allah Almighty for His blessing and thanks for being able to attend together at the International Guest Lecture, which was held virtually today. It would be nice if we can see each other even though we are not together at the same place. So I am asking the participant in the event to open the camera, please. Okay, before the event start, there is a saying that kalau tak kenal maka tak sayang. So allow me to introduce myself. My name is Tiani Larasati, and I will be serving as the moderator of today's event. It is a pleasure to be here with you all, and I welcome you all to the International Guest Lecture with the theme, The Role of Accounting Information for Decision Making. First of all, let us pray according to our respective belief to hope for a blessing, healthy, and smooth implementation of today's event. Prayers are welcome. Pray and. Ladies and gentlemen, to start this event, let us sing the national anthem Indonesia Raya.
Oke.
Okay, today's event is attended by the head of the accounting department, the Honorable Mrs. Dianatin Irafahmi, SPD MED PhD, the coordinator of the Master of Accounting Study Program, the Honorable Mrs. Dr. Makarenawati, SEMSI AKCA CSRS, and the Honorable Mrs. Helyanti Utami, SEMSI AK PhD. Ladies and gentlemen, the next session is a welcome and officially opening, which will be delivered by the head of the accounting department, to whom we respect, Mrs. Dianatin Irafahmi, SPD MED PhD. The time is yours.
Thank you, Tiani Larasati. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam.
Very good morning, everyone, ladies and gentlemen. First and foremost, of course, let us extend our gratitude to Almighty God for His blessing, allowing us to gather here this morning for the International Guest Lecture. So this International Guest Lecture is organized by the Department of Accounting, particularly by the Master of Accounting program that was coordinated by Dr. Makaryanawati. Thank you very much, Dr. Makaryanawati. And we are in the Faculty of Economics and Business, Universitas Negeri Malang. In this occasion, I would like to extend our deepest thanks to Dr. Parulian Silaen from Wollongong University, Australia, for taking your time and effort to join us today and share your valuable insight on a topic. If I'm not mistaken, the topic is the role of accounting information in decision making. Again, Doctor, we are very grateful for your presence and expertise in this event. So, Dr. Parulian, as you may know, the Department of Accounting comprises 3 study programs. So we have 3 study programs here. The first one is Bachelor of Accounting. The second one is the Bachelor of Accounting Education that is dedicated to educate pre-service accounting teachers. And the third one is the Master of Accounting program. And then hopefully in the near future, we could create another program that is Doctoral of Accounting program, but we're still trying to prepare it. And then all this program, of course, is dedicated to providing high quality education and training for our accounting students to become competent professional in the field of accounting. And then Dr. Parulian, we hope that this event will pave the way for further collaboration, of course, between Wollongong University and also my university here, Universitas Negeri Malang, and especially for the Department of Accounting. We believe that by working together, we can enrich and expand our knowledge and practices in accounting at both institutions. And as you have noticed before, perhaps in the near future, we could ask you to like reviewing our curriculum because the Master of Accounting program would like to reconstruct the curriculum. We have a regularly effort to like look at again and again the curriculum, whether it is suitable enough to meet the demand of the marketplace. And so for that reason, we need someone like you to like reviewing our curriculum. So hopefully you could be with us again in the future and then make a further collaboration with us. And then lastly, of course, I would like to thank Dr. Makaryanawati, the coordinator of Master of Accounting program, and also Ibu Helianti Utami, and also other accounting lecturers here. And for the team for making this event possible, thank you very much. And for my dear accounting student who participate in this event, thank you for the attention and the participation. Enjoy the guest lecture, and hopefully we can gain valuable insight from this event. If you have any question in mind, please do not hesitate to ask Dr. Parulian. Hopefully Dr. Parulian will be so happy to answer all your questions. Thank you. Thank you very much. And wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Thank you, Mrs. Dianati Irafami, for your welcome. Ladies and gentlemen, the material that will be discussed this morning is about the role of accounting information in decision making. So, how can accounting information help management in decision making? Everything will be discussed with the speaker who is present with us this morning. He is a professional management accountant, financial control specialist, lecturer, and practitioner. He earned this bachelor degree from Universitas Indonesia and a Master of Commerce degree and PhD degree from Wollongong University. He also worked as a consultant for a number of organizations developing accounting and control system. Then his research interests are management accounting, management control system, and performance audit. Oke, sebelum kita sambut narasumber kita ini, saya punya pantun sedikit ya. Bulan di langit bersama bintang, kopi diseduh dengan air. Kami ucapkan selamat datang, terima kasih kepada Bapak telah berkenan hadir. Oke, let's just welcome our speaker, the Honorable Mr. Dr. Parulian Silaen, SAM.Com PhD CMA CSRS. Our speaker is here with all of us. Today's agenda for the first session, he will deliver material for 135 minutes. Then the second agenda is a question and answer session and discussion with event participant for 30 minutes. And then the participant can ask question directly via the raise hand or via chat, and later the selected question will be discussed together with the speaker. And then prepare your best focus. We welcome our extraordinary speaker, Mr. Parulian. The time is yours.
Thank you. Thank you. Thank you. Thank you. Do you want me to start now?
Yes.
Okay. All right. I would like to share my file first. Right. Can everyone see the file?
Yes.
Yes, can you? All right. Okay. The first thing, I would like to introduce myself. My name is Parulian Silaen. Right. And the other thing is like you mentioned before, like Miss Diana saying about the collaborations of between us. And I think that at the moment my role is as a personal individual come to discuss these things and guest lecture to University Negeri Malang, and not affiliated basically by bringing the University of Wollongong, but I'm willing to help if you need any more, like I'm doing the review of your curriculum for master or even for undergraduate. I might give a contribution. I don't mind to do that because I'm still Indonesian and I would like to contribute to my country as well, to Indonesia, as much as I can. Thank you very much. All right. Now, basically, I arranged this a bit different of the one that Miss Tiani mentions before. I try because I don't want to make it too long into before the student come to because the attendees come to asking question. So what I expected to do is I try to split the my topic into two sessions actually. So the first session, we're going to have a bit of a break so the attendees can ask questions, and then for 5 or 10 minutes or whatever, and then we can continue to the second session, and then another session for question and answer questions in the second session as well. But it is doesn't matter because I don't want to get the question and answers at the end because it's going to be too long. The attendees may not be able to cope with the topic that they want to ask. Okay, so please, I will provide the session by the end of the session. I think that I prepare like a 20-25 slides in there, so we have a lot of time to absorb that and discuss that and asking questions after the first session. Then we start to the second, and then the question and answers again in the second session. All right, within the time frame. 130 minutes, 120 or something like that, I think. Is that okay, everyone?
Yes, that's okay.
Okay, all right.
Thank you, Doctor.
That's okay. Now, let us start with the first session. I'm talking about the role of accounting informations for decision making. Right. Now, the first question is, what is accounting? Because it is very important to understand what is accounting, basically, why we are talking about the accounting information. So we need to know what is accounting. So according to the literature that we may find it everywhere, but people put it differently. But I would like to quote this accounting definitions. Accounting is a concern with the collection, analysis, and communications of economic information to make a sound decision, planning, and control. That is, basically, if you look at that, the analysis, communication, collections of data, economic information to make sound decision, of course, this is going to be related to the informations that we are going to discuss today, more focused. Right. Now, why is it accounting important? Why is people would like to say that, oh, accounting is very important. Some people may say that accounting is the blood of the company. So without accounting, the company will working like a blind man that doesn't know where to go because there is no directions to lead them to do the better decisions. That's part of the importance of the accounting. Now let us see what does it say. it says that the accounting will assist people to make decisions. And then decision to what? Decision to allocate, to use the scarce resources, right? So it's like the human resources, the money, the fund, the budget, the activities, the people have to make a sound decision, and this decision will be led by the accounting information, right? So these are the example: the new product or service, change the price, the quantity, borrow money, decide the scale of the business, and productions, purchasing, and distributions of the product to the customers, right? And the second thing is important because it provides information. Like I mentioned before, is to assist the users to understand about the past, which is more focused on the financial accounting, and the present and the future position of the entity, of the company, which is part of the area of management accounting. So I try to cover up both, but later we will focus more in management accounting. Right. And the third is it is a mean or a process or method of measuring the business activity and communicating this information to decision makers. So this the accounting, why make the accounting is important. Now I'm trying to bring a couple of the uses of the accounting data. It could be the customers, the owners, the competitors, the managers, the employees, the lenders, the government, the suppliers, the investment, and the community. If you look at that, this is the business organizations. And if you look at that, we can see that the user of the accounting data can be categorized into external and internal to the company or the entity. Now, there are three things that I would like to link together, but before that, I would like everyone to understand that we are talking about financial accounting, management accounting, and cost accounting. What are the relationship among these items? Right. Financial accounting is the accounting that prepares report that most frequently used by the external, right? That is the outside of the organizations. While management accounting prepared for the internal. So if we go back to this, for example, the owners can be internal, customers is the external, competitors external, managers would be internal, employees will be internal, lenders probably outsider or the external, government external, community outsider, external, investment analysis is outsiders, and suppliers, right? So we can see there, these are the consumer of the financial accounting. Now let us see about the management accounting. This is the management accounting is for internal purposes. Now, what is cost accounting? Cost accounting basically is a method for measuring the cost of project, process, or the things that activities of the company, including both financial and sometimes non-financial. For example, the number of units sold, and then the customer satisfactions, and also the competitors' degree and the cost of the product that may talking about the quality and the features of the product. They're part of the non-financial information that may also absorbed by the cost accounting, because the quality and the feature of the product may create the higher or the lower cost of the product, which is in the area of cost accounting, right? So we can see that the relationship among these three aspects can be clearly related one to another. Now, we can try to bring the differences between financial and management accounting. Financial accounting, for example, in terms of 1, 2, 3, 4, 5 to 6 nature of things or items. One about the nature, the level of detail, the regulation, the reporting interval or the time frame, and the time horizons, and the range of the information. Financial accounting must follow the GAAP, they call it General Accepted Accounting Principle, while management accounting don't have to. Management accounting doesn't have to follow the GAAP, but because they have the specific purpose. It's not always in the past. It's not always documented by the voucher or invoice, but the management accounting can be an estimated, can be relevant to the outside world, something like that, okay? So level of detail, this is a broad overview. It is more aggregated, considerably more detailed. This is regulation is legal and have to follow the accounting regulation and standard. the management accounting must meet the design to meet the needs. So we design it differently. So if you look at the management accounting informations, they will be designed to different company in different way, to different product, different industry, different areas. For example, for the hotel, a management accounting reporting system is different to the hospital, and the hospital to the retailer will be different. So manufacturer also different. So that's why the management accounting in terms of the reporting interval is going to be different as well. So for example, we can see here reporting interval for the financial accounting. It can be annual or half yearly. They call it in the half years, it's like 6 months, right? And then the management accounting could be frequently as much as needed by the management. It can be weekly, can be monthly, can be 3 months, can be 6 months, and so forth, right? The time horizon, the financial accounting is backward looking. This is like a past, like in the past. This is the history, what we have done in the past. That is financial accounting, while management accounting is more to the future oriented. The range of information, financial accounting more focused on monetary aspect, while the management accounting can be quantitative in monetary aspect and also qualitative information. Right. Now, financial accounting can be seen as a service to provide financial information to interested users, which is called stakeholders. Therefore, in preparing the accounting information, we need to follow the guidance of one is the underlying the assumption, the qualities of the information, and the measurement principle of general accepted accounting principle, right? So I think that these things are already been learned in accounting subject in the very beginning, right? And then let us see more in detail one by one. For example, the quality of financial accounting info. The accounting info must contain the qualities. The qualities is also the qualities of the accounting information also stated by the accounting standard and accounting principle. Right. One is the relevance, and the second is faithful representations, and then the third is comparability and consistency. It means that relevant in making decision and also faithful representation. It has to be faithful representation of what happened in the company, and comparability and consistency in terms of the construct, in terms of the structure in financial accounting has to follow the structure of the information of the report. What are the report of the accounting information, which is the financial statement that we have, balance sheet, income statement, and some the cash flow statement as well. Those are the information that has to be set up in the certain way according to the accounting report. And that is because it will be comparability. It can be compared from one company to another, or from one company from the different period. And that's why they call the construct or the structure of the report has to be consistent, so it will be able to be compared. And verifiability, it has to be verified, and the timeliness. And the timeliness have to follow the time, because every 6 months or every year, and we have the cut-off period. We can't change that. We have because this is the consistency and comparability as well. And the information has to be understandable. So that's what we call the understandability, because what it means by asset, what it means by cash, what it means the account receivable, it has been stated in accounting standard. And to follow that, then we can understand the figures of financial information that represents that information will be followed that standard, and we can understand what they are. Right. And materiality concept. Materiality concept, it means that the value of the item that we report there is material, which is the significant amount in regarding to the company activities or value. Right. And then also must contain the ability, could be used as a cost and benefit. Right. Now, we will look at the management accounting. Management accounting is a bit different. Management accounting provides financial and non-financial info, sources for analysis and communication to decide to generate and preserve value. Right. So probably you can find more or different way people to describe the management accounting in different textbook or different authors. So it says that it serves managers by providing the information needed, right? However, it affects and is affected by other relevant variables and operates in context. We will talk more in details on this later, what the impact of the other variables and what will be the effect of the management accounting to the users. Right, now, let us go to a bit of a key of the management accounting guidelines. Right, there are three key management accounting guidelines that we are going to discuss here. One is in the management accounting, we have to follow, this is the most important thing. One is the cost benefit approach is commonly used in management accounting as a basic decision rule. Then to give the benefit, generally the benefit must generally exceed the cost. That's what we are using the cost benefit analysis. Right. Now, the second is behavioral and technical considerations. So people are involved in decision, not just dollars and cents, right? So in management accounting, we need to consider not only in the matter of profit, of the cost, of the revenue, of the income, but we also need to consider that people that create that, the people that work in the company are human beings. We have to consider about their learning process, they enjoy the work, the environment, the work environment, and how they feel about the company. Because if their mind is outside of the work, and then the quality of the work will be questionable. Right. The third is different definitions of cost may be used different application. As in many other domains, one size fits all. Does not apply in management accounting, because in management accounting, different costs serve different purposes. We know that in management accounting, we learn a lot of terminology. We learn a lot of names of the cost. For example, we have variable costs, we have fixed costs, we have the operating costs, we have the production costs, we have the non-production costs. They're all terminology. And then, but sometimes if you look at inside, they are the same things, but we name it differently. Why do we name it differently? Because it's served in the different way. So we name it a different way, right? So that's what the definitions of different costs and different costs and different purposes in management accounting concept. Right. Now, there are a unique characteristic of the skill of the management accountant. So we need to know this to make them enabled to, one, to work well in cross-functional teams and as a business partner. And the second is to promote the fact-based analysis and make tough-minded critical judgment without being adversarial. And the third is lead and motivate people to change, to be innovative. Right. And the fourth, it communicate clearly, openly, and candidly. And the fifth is have the high integrity. And these are the unique characteristics and skill of management accountant. I just would like to tell you a bit of my experience. I've been experienced when I graduated from the accounting school long time back. I work in accounting firm as an auditor. So I work in the accounting firm, and I did do the audit, the financial audit of the client. And I did that for a couple of years, and then I get a job as the internal auditors of one big company before, and I work as the internal auditors, and I become the senior internal auditors. And I look at that the role of internal auditors is more as management accountant rather than the financial accountant, because the management asking me, what it does mean this? If you want to invest this, what do you think? And what do you think about our competitors? How can we beat them? What is our strategy? And then we discuss that, not merely talking about financial aspect. So that is the role of management accountant that in my experience is a bit different compared to the financial accountant or CPA. Right. Now, once we get that, now let us see the key influences of the management accounting accounting system structure. So the management accounting system, which include the management accounting information system, because the information system of the accounting in the company usually will be designed and also involve the management accountant to give the contribution to make the structure of the information system to be applied in the company, because most of the information are related to the financial information. Right. But in preparing or in setting or designing or developing of accounting information system in the company, it may be influenced by other or many things. One of that is the organizational structure. Because in creating the organizational structure, sometimes let us focus on the two types of the structure. One is centralized and decentralized hierarchical or flat structure, right? So this structure, centralization and decentralization structure, may require different accounting information system. And also the flat structure and hierarchical structure of the organizational structure may also require different accounting information system structure. So that is one of the key aspects that need or can influence the information system structure. The second is availability of information technology and the use of that technology as part of the information system interface. So the information system technology, as nowadays we are living with the computerized system, and then the information system, we are using now the internet and as our helper to provide the better information system. So this information system technology will influence the structure of the information system that we are going to provide or setting in the company. I remember a long time ago when I worked as the internal auditor, like I mentioned, I worked in the one of the a big company that owned as a, it has the like 11 subsidiaries, and I work in the head office as the internal auditors. And what we did at that time, then in the world, especially, we are starting to introduce one of the computer, they call it IBM 2000. And the boss asking me, do you know about the computer? And I said, I don't know, because I used to be in manual, because I learned accounting. We don't have the computer at that time yet. And then he said that now we are going to be modernize our information technology. Can you design a bit of this, blah, 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 to make our information system getting better? And I said that then I can contribute. I can involve in that project. And then I involved in that project, and I designed the accounting information system, and I worked with the one of the programmer. And then he deciding to make the command and the system of the software. And then we run it. I did it like a 1 year, and then we did the running trial for 6 months. And then once it is applied after the modification, after that we continue that doing that using the computerized system. That's what my experience. The technology is changed, and now we know that the company also need to change. For example, if you go to the supermarket, it's no longer the supermarket. You have to type in the code of the product that sold by the supermarket. They just put the barcode and then beep, 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 beep to the machine. And then the one beep is the credit is the sales. So one beep, the sales, one beep, the sales. So we don't need to do the journal entry anymore. Probably we use the system. It's already journalized the transactions right away and put it into general ledger and reporting to the management, the accounting system of the company. That's an example of the role of information technology. Now, the third is organizational strategies, such as if the company use the low cost rather than the high cost strategies, and they might require a different information system structure. And also differentiation strategies. So for example, the strategies can be low cost strategy or high cost strategy, differentiation strategies, and so forth. And though also we need to look at the phases of the product and so forth. The strategies, different strategy, different way, different concept, we need a different information system structure. That's what I can say here, to be aware for everyone. If you are, after you finish your study, because you are the postgraduate, some of the attendees that I can know from the email that came to me. So I means that some of you already been working in the industry, and you might that you need to understand this all of aspect. They may affect the information system structure that you're going to apply in your company. All right. Okay. Now next is we go to organizations' view of management accounting, such as proactive or reactive role, information providers role only, or including decision-making role. And types of decision confronting managers, such as long-term or short-term decision, they need information system structure differently. And the sixth is some external influences, such as environment and as other regulations. So for example, nowadays the company need to prepare the environmental report, and then the accounting system or the information system structure need to facilitate the information about that for the management can make decision. Now, information for decision making. The two kind of information in the context of decision making. One is the relevant or irrelevant information. What it means by relevant info. Relevant info will have the information that help the decision makers to evaluate and choose among alternative courses of actions, right? So then relevant information is the information that concerns about in the future. The relevant information is not in the past. And then usually the relevant information means that relevant to the decision that we are going to make for the future. And then it varies with the action taken, which is not only one, but it can be different, right? So relevance of information depends on the type of decisions and other factors. This is often referred to as different costs for different purposes, meaning the decision at hand and the nature of the cost object determine the cost data required and how much such data might be used. Right. Now, irrelevant information is the information that does not vary with the action taken and therefore is useless for decision making. It's only one information that we can do. That is irrelevant information that we can say. So relevant information must be very concerning a different alternative choices. Right. In the information, we have two issues. One is the quality and relevance of management accounting information, the quality of the information and the relevance of the information. We'll talk about the relevance already. The higher the quality of the information will generally have fewer uncertainties. So in the information, level of uncertainty is something that we are not sure. That's what we call as uncertainty. So if the uncertainty is great, big, many, then the quality of the information is low. But if we can have the uncertainty is unavoidable, but uncertainty, when we have uncertainty, is fewer, smaller numbers, and then it will be called as the higher quality. And also if it is based on viable assumption, right? And then the quality of decision-making process by using the quality information will be the increase or lead the quality of the decision-making process that we need to consider, right? And the better quality will result in the better quality of the decisions as well. So these two things are linked one to another, quality and relevance of the information, and it will make or lead or help the management will make the quality decision-making process. And of course, later at the end, the result will be the high quality or the better or the best decision-making made by the management. We can see, for example, the high quality information, which is the information that more certain, complete, relevant, timely, and valuable. And this higher quality information will lead to the higher quality of the report that are more relevant, understandable, and available. And then this higher quality report will make the decision-making process will be more true, unbiased, focused, strategic, creative, and visionary. Then it will come to the higher quality of the decision that made by management. Okay, so these are the link among these informations and the decision-making process. Right, decision useful information need to be considered in the light of opportunity cost. And we will talk about what is opportunity cost later on. And then also in the light of cost-benefit analysis, you know that the management accounting information is mostly influenced by or contains of the opportunity cost and cost-benefit analysis as well. Right. What is opportunity cost? Opportunity costs are the benefit foregone when we choose opportunity one alternative over the next best alternative. For example, we have several activities that we are going to make. For example, are we going to produce, we already produced 10 products. Then we come to have an idea that the market would like to very demanded now the new product, which is a product A, for example. Now the decision we have to make whether we are going to make that product A or not. If we don't want to make that product A, then we lost the opportunity. That's what we call as the opportunity cost. And then cost-benefit analysis is an evaluation of the benefit derived from the information and the cost of collecting it. Now, we look at the value chain analysis. What is value chain? Value chain is basically at the beginning, long time ago, it's been created by one of the professors. His name is Michael Porter. He's a very famous man. And then Michael Porter introduced the idea of value chains in 1980s, right? What is value chain? Value chains consist of the key activities engaged in by an organization or industry. That is the value chain. Value chain is the activity of the industry or the company from activity 1 continuously followed by 2, 3, 4, 5, 6, 7, and so forth. So the whole the pace of the activities in the organization, there's related one to another. That's why Michael Porter defined that as a value chain. At the organizational level, the value chain is usually viewed as a combination of key activities and support activities. Well, at the industry level, so we get the organizational level as a whole, and the industry level, the value chain comprises the key industry component based on the key activities within the industry. Right, now the value chain provides a suitable framework for considering a range of management accounting issues, because every one change which is represented by the activities may involve the cost and benefit there as well. So that is the management accounting has the important role on that. We will see here an example. For example, the value chain analysis of an industry. Industry, what industry? The wine industry, for example. So we have the vineyard. Vineyard is the activities of grape growing and harvesting, like the farmer have that in the farming area, and they growing the grapes and the harvesting that. And the second, once they get the harvest that the grapes, and then they put it the process into making the wine productions. When they make this is what we call it, the activity is winery. Then goes to after winery, the wine production have to be put into the bottle. They call it bottling and packaging. And then it will be distributed to the wholesaler or the distributors. And then after that will be the distributor will sell it to the retailer, and then the retailer go to the customers. This is what the value chain from 1 to 5. For example, company A may do the activity from 1 to 5, while company B will be only use the vineyard, but just to grow the grapes and then harvesting it. And then the winery productions will be done by company C. For example, company C do the winery productions here and then bottling it. And then after the bottling and the distributions may be done by the company D, for example, distribution and retail. So these are the situations that we need to understand, right? This is the value chain analysis. Where we are now, we need to know where are we. Are we going to do from 1 to 5, or we will collaborate with other company? We are just doing 1, 2, and 3, and then 4 and 5 doing by somebody else, or we are doing this 1 and 2 as well only, and then these 3, 4, 5 will be done by other companies. So the information system will be related to that as well. Okay, excuse me. Now, value change, it is good because the good of value change because it focuses on activity and process, not the functions or department. If you look at here, we are focused on the activities here, not the department, the sales department, purchase department, accounting department, human resources department, not based on that. We based on this activity across the chain, right? And the second, by using the value chains, it will encourage a broader organizational view by considering the consequences of decisions, whether to upstream to R&D or downstream to the customer support. If you look at here, we can see now activity is greater. We can look at that not only in our company, we may consider that other company competitors or other company that will be collaborate with us. So that's what it means in the second part. Right. And the third part, the value chains will break down more traditional representations of the activity by encouraging communication at higher level of cross-unit and business segments. So all of the activities that will communicate one to another. And then the four is the externalized thinking by incorporating suppliers and customers as well. Then we can see in that value chains already. And then we will see number 5 with the value chain reflects relationship in terms of cost transfer in every value added activity. If you want to continue doing that from 1, 2, 3, 4, 5, there's going to be a cost transfer from the vineyard activity. The cost from here will be transferred to that, transferred to that, transferred to that, transferred to that. So if you learn like in the process costing, there is the process costing. If you see if the process of the product may continue from a 2 or 3 department, so the cost from the department 1 will be transferred to the second and the third and so forth until the end. Okay, so this will be what is it says by the transfer pricing in every value added activities. Now, the 6th is the focus on activity and value chain. We can see because their structure will be put into the activities, then it will be easy to look at that using the activity-based costing. Everyone knows about the activity-based costing, haven't you? I hope so. So it will give the idea of the activity-based costing that we can analyze on each of the change or activity that I have shown you in our flow before the flow chart. And then the value chain serves as the foundation for decisions such as outsourcing part of the value chains or the formation strategic alliances with, say, a distributor. So like I mentioned before, if we are going to do just activity 1, 2, 3, and then we can see whether the activity 3, we will go outsourcing to ask the other company to do it. For example, we don't want to do the bottling, so bottling can do by other company. And now we can make the negotiations about the cost, whether the cost of those company will be lower, then we make it ourselves. If it is lower, then it is better we do the outsourcing. And then support initiative like supply chain analysis. A supply chain analysis is the flow of resources from initial suppliers through the delivery of goods and services to customers and clients. And the 9 is enable the financial measurement of downstream. Downstream, it means that from research and development, and then the before the productions, and then the production, design the products and the production, until the end we sold the product to the customers, and then we get the after the sales service because we need to guarantee that our product, for example, that is the end of the activities. So it can be seen of those activities. We can able to measure that to downstream from the upstream to the downstream. Okay. So the third is we can be able to categorize the activities as value added and or non-value added. So we look at in the value chain, if the activity is non-value added, we can delete that activity in non-value added, or we can, if it is non-value added, we can do it from outsider. We can use the outsourcing, for example. So these are the benefit of using that value chain analysis, but but that developed by Porter. Right. Now, let us see again about the supply chains, right? The value chain and supply chain is a bit different. The supply chain, it's a flow of resources from the initial suppliers through the delivery of goods and services to customers and clients. This is what we call as supply chain. The value-added activity is necessary here, and that the customers would normally prepare to pay for. So if the activity that we have done, it is not has the value added to the customers, and then the customers doesn't want to pay that. So if, for example, you make the product that adding up a bit of the color or the cover that is not necessary, and then you add up the cost, and then of course you will add up the sales price, and then the customers normally doesn't want to pay that. They're going to go to your competitors, then going to be left by them. Okay, so that is, we need to understand the value added activity. While the value added, so when it is value added, they would like to pay that, but if it is non-value added or unnecessary, the customers doesn't want to pay that. So we have to be able to analyze that. How can we analyze that? So we can see this is the value change. For example, the activities from the normally for the organization. They're starting with the research and development. For example, the research on the wine varieties, what kind of the varieties of the wine that we are going to put into our field, and the productions and process of innovations. And then after we get from the research and development activity, we get the better varieties to put it into our garden and to our farming. And then we make the productions process to make it. After getting from the research and development, then of course, go to the next step is to design, system design, and then how are we going to produce that? This is the productions and management accounting system design. What kind of information that we need to know? How much is, if we get the research and development probably has the several option or choices, then we can, management accounting, have to evaluate each option, which one is the better, right? And after that, go to the inbound logistic, and then go to the supplies of grapes, packaging, productions, material, and support department supplies. Once we decide this, then we start to the production. In production, we produce the wine, including wine production and bottling. And after that, we all of this activity need to be supported by the support unit, such as accounting, human resources, information technology, and purchasing department, and so forth, right? So once we know this, we have to be able to analyze the value added and non-value added activities. Let us see whether we can, what are we going to do with the value added and non-value added activities. For example, we analyze the activity. There is a necessary activity. However, this activity cannot be improved upon at this time. If that is cannot be improved, so we leave it, and the action to improve the value is none. So for example, another necessary activity that could be changed, we can improve the process, and then we have to modify this process. For example, we rearrange the plan layout, and then the material handling activities, or the quality of the materials, for example. So for example, we find out the unnecessary activity that can eventually be eliminated by changing the process. So we change the process that can avoid, or we don't need to do that unnecessary activities. For example, eliminate the manual recording of employee hours using time card, because we can use the when they access to the office, they can face crossing the face that's been recorded that they're in. So a new payroll system eventually implemented. Plastic ID card, for example, they just tap it into the machine, they don't need to fill up anything else. So it's been recorded by the detail into the computerized system. So these are the action to improve that. The unnecessary activity quickly eliminated by changing the process. For example, in a team manufacturing, inspections of unit completed can be eliminated if each team member inspect each unit before pass it to the next step. So if every unit before delivery transferred to the other department, they have to inspect that, check that clearly, and if it is done, and then go into the next department doesn't need to do the quality check anymore. Right, information system for external and internal. Right, these the company may have the database and software. The information may come from the internal or external. From the external, and this is from internal. This is from external. This is from internal. Then they are going to put into the database, and the software will process that to become external reporting and internal reporting. Internal reporting is for the management, can be capital budgeting, product development, analysis, potential acquisition, and so forth. Yeah. And the external reporting is the financial statement that they produce by this software to be consumed by the shareholders report and the stakeholders report and the government's report. Okay. And once we do that, so we go to the management accounting again back, we can see the major differences between management accounting and financial accounting, the purpose, the uses, the focus, the rules, the time span, and the behavioral implication. We can see management accounting and financial accounting. I think that I don't need to read this. Later on, I think that you can download the slides. I think I hope that the committee can provide it to all of the attendees. Right. Now, sometimes in the nowadays, the company need to concern about the environment, right? So the environment report, I think that the company need to prepare as well about what kind of informations that they need to have. And this has to be provided by the information system. For example, the sustainability, which is we have to understand that the development that meets the need of the present without compromising the ability of the future generation to meet their own needs. And then management accounting here regarding the environment can identify the relevant cost and benefit by considering the environment. So by not using the fossil energy, for example, we're using the solar cell, and then how much is the cost of the solar cells they compare to the using the petrol or the fossil energy, right? And also management accounting can use the activity-based costing to look at how much is the cost if we are talking involved with developing the environmental responsibility, carrying out the cost-benefit analysis of sustainability initiative, how much is the cost of that, what is the benefit of that. But nowadays, especially in the developed countries, most of the customers, they're very aware whether on the company's awareness about the environment. If the company doesn't aware about the environment, then in the developed countries, especially I can feel that like in Australia, many of the customers try to avoid the product of that company. So they would like to see people more have the social and environmental responsibility. Right. Sustainability is the ability to continue a defined behavior indefinitely and compromises. So we need to have the environmental sustainability, and also we need to understand about the not only environmental, but we need to also have the economic sustainability, in which the ability to support a defined level of economic productions indefinitely, and then the social sustainability, the ability of social systems such as the country to function at a defined level of social well-being indefinitely. As much as I'm concerned, I try to I have the bit of attending the conference, the training on the this is the social and environmental responsibility in Indonesia, for example. Many of the company in Indonesia, especially the company that already listed in the stock market, or the state-owned company, for example, they are more concerned about social sustainability. They don't touch the environmental and economic sustainability yet, not yet. So not much of them touch that yet. So, but the most they call the social and the environmental responsibility. They're just looking at the social sustainability, helping people in the small medium enterprises or something like that. Okay, but in management accountant, for example, it has the role into those three of sustainability. Be aware of that, because it is needed later on when you're finished, graduated from your accounting, get your accounting degree, and then if you go to the international market, you are maybe asked to be able to understand that and what is the impact that to your role as a management accountant. Right, now let us see about the strategic decision and management accounting. What is strategy? Strategy specifies how an organization matches its capabilities and opportunities in the marketplace to accomplish its objective. The strategic cost management describes cost management that specifically focuses on strategic issues. Management accounting can help to answer the important questions, such as who are our most important customers and how do we deliver value to them? So these are part of the strategic cost management, right? So we need to not just to put the strategy without knowing what happened in our business, right? So in our business, we need to know who are the most important customers that we need to support. We need to make them happy. Or who is our customers that are very low in purchasing the product? And then what can we do to improve that? What kind of support that we can make to make these customers will buy more? That's part of the strategic decision cost management that we are needing to make in this strategic decision. What substitute product exists in the market as our competitors and how they are different to ours? And then what are the functions of they are different to our product? What are the quality that they have? What are the price that they have? This is part of the information needed by the management in creating the strategic decisions later on. And what is our critical capability? We have to measure about our strengths as well. What is our capability compared to our customers, our technology, productions, marketing, and so forth? It is needed. The information system need to prepare this as well to the management to help them to make a sound decision, right? Will we have enough cash to support our strategy? Or we will need to seek additional resources, other businesses, or we need to create other supporting from other businesses as well. So these are the part of the things that we need to make or to understand, to look at, and to make our strategic decision is better. Right. Strategy relates to how management match an organization capability with the opportunities in the marketplace and to accomplish its objective. In forming strategy, the management must understand the organization and its environment, often through approaches like SWOT analysis or strengths, weaknesses, opportunities, and threats analysis. I think that in management subject, I think most of the students already known about what is SWOT analysis means. And then SWOT analysis will help management in assessing the potential and strategy by identifying, analyzing the strengths and weaknesses of the company and capacity and capabilities and the opportunities and threats that prevailing in its environment, which is using the external analysis. Right. Now, management accountant can help and work closely with managers to focus specifically on strategic issues and then to formulate strategy by providing information about the sources of competitive advantage and helping to answer strategic questions such as who are our most important customers and how do we deliver value to them? What substitute product exists in the marketplace and how do they differ from our own? What is our critical capabilities? Will we have enough cash to support our strategy or we will need to seek additional resources, right? So these are the things that we need to have, and the management accountant can help to answer this because those the information that we like to have in the company and that will be set up and arranged by management accountant and giving that to management so the management will be helped to make a sound or good decision. Right. And then also we need to be aware about how can the management make decision. There are 5 steps to guide the decision. It is suggested to apply the 5 steps of guide to make the strategic decision. One is before the decision is made, we need to identify the problem, right? Profit have fallen caused by some aspects such as revenue eroded, cost of the price increases, volume decreases, competitors increases in the market, and their product is more sophisticated than us, their price is lower than us. Then nowadays, the problem is a problem to be identified. It's not easy to identify the problem. So the problem can be related one to another to different aspects. So we need to clearly identify what the problem that we're dealing with. The second, once we identify the problem, we need to gather relevant information. That's why the role of accounting information is important. We need to collect information about the cost and revenues more in detail in each of the activities, like we have seen in the value chain activities. And then identify and evaluate potential causes of actions by, for example, reduce operating costs, increase selling price, increase advertising rate, reducing the cost of the productions, for example. So we need to identify that for step by step, and we can reduce the cost as well. And make and implement a decision, maintain operational level, continuous improvement, add value with reasonable cost, maintain the price, increase advertising rate, or if we can, by using the Kaizen system, for example, we can reduce the production cost by doing the innovation, and then we can keep the maintain the price. If the competitors is high, we can change the price to make it lower so we can compete our competitors in the market. The last item that I would like to convey here is to evaluate the performance and learn. We are using the performance report. So these are the 5-step guide to make a decision. Up to this, I would like to stop my presentation. I would like to offer if you have any question for the first session, and then we can continue to the second session after this.
Okay, thank you for the insight, Mr. Parulian Silaen. The participant can ask question directly via the raise hand or via chat. Okay, does anyone have any question? And then pertanyaannya bisa disampaikan dengan bahasa Indonesia ataupun bahasa Inggris. And I will open the opportunity for audience who want to ask question. The first part, the opportunity is given to 3 people first. If there is still enough time, we will continue to the second session of question.
Do you want to put I stop the share here so people can see my face or not? Okay, I put it this way.
Yes.
Okay, everyone. Yes, and Marie.
Thank you for the good presentation today.
Okay.
But with some question regarding management accounting.
Yes.
How can you elaborate management accounting information influence a strategic decision, particularly in the context of value chain analysis and its application in the real world scenario?
Okay. To arrange the information system, it's not easy. Okay. One thing, as a management accountant, we need not only to focus on financial aspect. For example, in my experience as a management accountant, I need to know about marketing. I need to know about the human resources. I need to know about the production system. Then I would like to interview them. What information do you want? What kind of information? And then I design the information, I design the structure, and I communicate with them. Is this the one that you like? And they will say, in most of the cases, they will say that, no, I want more. Okay, I modified that and changed that. This is the item that you like. And then they've said, okay, yes, they want. And then I would like to ask them, how frequent that you want this information? Do you want to get it like daily, weekly, monthly, 3-monthly, quarterly, and so forth? And all of this design, the structure, the contents of the information, then I will communicate that usually to the computer programmer. Right? And then the computer programmer will touch the software and start to create the information that we want in the system. Of course, I have to design as well what kind of the sources, what kind of information that need to be entered into the computer system as the data entry, and what are the value of them. And then I will design that one by one. Oh, this is for marketing, this is for purchase department, this is for productions, this is for the financing department. And I put the copy of that report to be distributed to them later on. So it is a step-by-step process. So different company may require different accounting system structure. So we do have in the market, they have the accounting software, right? So for example, Xero or Silaen or whatever, there are a lot of software in the market, but they basically, those package of the software is only related to the small, medium company, because it's a very generic software. If you are like the more complicated company, you have to design yourself. So that is the management accounting design system. But sometimes you design that it's good. You can look at the information requirement, and then you can set up the existing software. For example, the Xero software. We can change that. Oh, I want to this. Yeah, we can set it up. Yeah. But you have to understand the need, the type of the information, the structure, when, and the frequency of the information to be provided and to who. Does it make sense? Did I answer your question, Anne?
Yes, you did. And for the last, you said you used to be internal auditing.
Yes.
So how can internal auditing can be related or contribute to management accounting and decision making to ensure the accuracy and reliability of financial accounting?
Okay. Thank you for the questions, Anne. Right. As an internal auditor, I'm not making a decision. The decision is made by management. I'm just a supporter. So they for example ask me, excuse me, can you help me? Our customers is, so we have 20 customers. We will talk about how to implement that later in the next session, right? The implementations of the information system, right? And for example, they ask me, for example, how can we serve, which customers is the best for us? Which customers that we want to make happy, to spoil them, for example. So we have to do the customers' profitability analysis. We will see which customers is so dedicated and make a lot of contribution to our company. And we have to serve them better than others. Of course. For example, we can give them more discount. That is one example. But how do they know that? We have to provide the information. What kind of information? That analysis, we have to structure them, and then the management can get the information and they can decide, oh, we have this the better, this is the best customers, but this is a very low purchase. What happened to these customers? And then the marketing people may go to investigate to find out why these customers only buy, for example, 1,000 product a year, because we can see, try to look at, investigate that. Oh, these customers market, they can absorb a 10,000 product. Why they don't only buy 1,000? then we need to say to them, oh, okay, all right, and then they said that I don't have money, just I can't pay you if your credit is only 1 month time. For example, if that's the situation, then we as a management accounting need to arrange the information system. We can find out the information by taking that how long that the credit that we make to every customer. So for example, we can give them a bit longer. Okay, I give you 2 months, and then they will buy more. Does it make sense?
Yes.
Okay. Thank you. Anything else, Anne? Did I
No.
answer your questions?
Yes.
Oh, great. Oh, great. Thank you very much.
Okay, what a great answer from Mr. Parulian Silaen. Okay, next for 2 more question. Baik, pertanyaan bisa disampaikan dengan bahasa Indonesia ataupun bahasa Inggris ya. Mungkin 2 pertanyaan lagi dari teman-teman partisipan. Oke, mungkin sambil tunggu pertanyaan ya. Before entering the second session, we took photos first. Oke. Saya ingin bertanya, baik, dari Putri Indayani ya. Ini pertanyaannya mau raise hand atau langsung ngomong atau dari via chat? Putri.
Langsung aja.
Oke, baik.
Okay.
Hello, Doctor.
Hello.
Let me introduce myself. Thank you for having me here. I'm
It's
Putri
okay.
Indayani. I am a major Master of Accounting. I have questions. What are accounting standards in Asia and European countries now the same? Actually, they used to be different and there were gaps. Yes.
Okay.
Maybe.
Yes, I think that now most of the country, they try to adopt in regarding the accounting standard. I think that many of the companies now and a country in the world now, they are not develop their own standard. Rather, their standard will be developed in relations to the international accounting standard. Why is that? Because now the market is open to, there is no more boundaries. For example, the company that operate in Indonesia, the company is listed in the Indonesian stock market. The investors from other countries, probably from Europe or from the other countries, they don't understand if the standard is different to them. So that is why we need to use the international accounting standard. So our Indonesian accounting standard will adopt the international accounting standard. So we will use the same language. That will be the impact of that. Did I answer your question, Putri?
Yes, I standard.
Yes. And the information system that we have, of course, must comply if you are the listed company and we use the international accounting standard, but this international accounting standard has been adopted by the Indonesian accounting standard. Of course, that we operate in Indonesia, we have to follow the Indonesian accounting standard that already adopted using the international standard. So in an information system, we have to prepare that accordingly, according to that's required by the standard. Did I answer the questions?
Especially IFRS is the same in all country, maybe.
Yeah. That's what I mean. Yeah. But if you're talking about management accounting, like I mentioned in the slide, it doesn't need to follow the general accepted accounting principle. The management accounting information is not about the past. The financial accounting is about the past. The actual happened, and then we put it into the report. While management accounting is more the information that we need to provide for the future. So for example, if you do the business, how much is the cost of that business? How much is the profit of that business? And then we estimate how much is the budget and how much will be the profit that we are going to have by the end of the year if we make that product. But that is not actually happened yet. That is part of the characteristic of management accounting information. Does it make sense?
Yes. Okay. Thank you,
You're
Doctor.
welcome. You're welcome. You're welcome.
Oke, thank you. Pertanyaannya dari Putri Indrayani. Maybe one more question. Oke, Sania Rahmawati, boleh silakan langsung disampaikan pertanyaannya.
I'm sorry.
It's okay. It's okay. You can ask
Thank
in
you
English or in
for.
Indonesia. That's okay.
No, it's because my mic is
Yeah, it's a
not
microphone. It's
connected.
okay.
I'm
Yeah.
sorry. My name is Sania Rahmawati. I have question for Mr. Parulian. So, how is accounting information used by manager to raise concern about sustainability, especially during financial uncertainty, in example, and financial crisis?
Okay. Good. All right. Okay. In the informations of the environmental responsibility. Okay. So there are two things that we are talking about here. The environmental and social responsibility report can be dealing with the past. What have we done? Okay, so that is like the financial accounting. So in that report, especially in Indonesia, in many countries now, Asian countries, Indonesia, Malaysia, Philippines, Singapore, China, even many of the company in Europe, that is the rule and regulations that they have to prepare the social and environmental report. So they have to follow a certain standard. The most sophisticated standard, they call it GRI. GRI standard for environmental report is like the accounting standard. So when we make the report, we have to follow that standard. Okay. So in that standard, basically there are a lot of requirement of the standard to say that if you are consider about the environment, you are not supposed to have the suppliers that using the fossil energy, for example, using the petrol, using the benzene or solar in running the truck. So try to avoid that. So we try to avoid, trying to avoid that, then becomes the management accounting report. So management accounting will say that to set up, okay, if we want to comply with the environmental and social requests, we have to follow that. We have to choose our suppliers that is the suppliers that not using the fossil energy, for example. They're using the electronic vehicles. For example, they train truck that deliver the product has to use the electronic vehicles rather than using the petrol. And that will be supported, that they're proposed by the management accountant by saying that if we using these, right, the suppliers that not using the fossil energy, then we may need more cost, a bit more cost, but we will get more customers to buy because they identified that we aware of that. So that will be the analysis by using the cost-benefit analysis, whether we are going to comply with the environment. By complying with the environment, it will create an extra cost, but it will also receive the benefit by more revenue. So cost and benefit, cost and benefit analysis, we will see which one is better. And that will be for the long-term decision. Did I answer the questions?
Yes, thank you very much for the
That's
answer.
okay. That's okay. That's okay.
Oke, untuk sesi pertanyaan, untuk sesi pemateri yang pertama ini, sekiranya sudah cukup ya pertanyaannya. Iya.
Kita masuk yang kedua.
Mungkin before entering the second session, we took photos first. Jadi foto bersama dulu. Even participants are requested to open camera. Oke, dimohon semua hadirin untuk open kamera dan kita foto bersama ya. Dalam hitungan ketiga senyum 1, 2, 3. One more. 1, 2, 3. Okay, thank you.
Thank you.
Okay, let's move the second session. Mr. Parulian Silaen, the time is yours.
Okay, I think that we can move to the next. Right. The next is session 2. Now, in session 1, we have discussed the accounting informations. Now we will discuss how the accounting information help management to make a sound decision. Right. Internal and external parties analyze the financial statement for different purposes. Right. So the external party, they use the financial statement, they use the income statement, balance sheet, and cash flow statement for different purposes, right? So that is for the internal and external party, using that differently. For internal party, for example, the past activity, the past result, which is presented in the financial statement, for the internal party, then for the management accountant, for example, it can be used to evaluate the performance of the employees. How do they achievement in the past? It can be used to compare the performance of different divisions. It can be used to prepare the financial projections, is for example, as a stepping stone to base what we are going to do in the future. Because in the past we have done this. So we maybe modified that, and we can use that and then to make a prediction for the future. And then it may be used to compare the financial performance with competitors and improve the firm's operation. So we may be using that as a comparator to the benchmarking to the other companies. What are we good or bad to them? So we can use that because the financial information, the financial statement, all the company must use the same standard, and they have to publish that in the financial report. the listed company, they have to prepare that in their website, on the website of the stock exchange, so people can know what's going on to their company, right? So we can use that to compare ours to them by using the analysis as well. While for the external parties, which are, for example, banks and other lenders, use the information whether they are going to lend the money to the company or not. And then the second, suppliers may be deciding to grant credit, but the suppliers might deciding by using that to grant the credit. And then the credit rating agencies determining the credit worthiness. So the credit rating agencies may assess the company's worthiness, credit worthiness, whether we are a good credit, lenders, borrowers or not, right? So individual and investors deciding to invest in the company, and they need to know how good the company, and they are going to invest that to our company or not, right? The professional maybe analyze that by using the about the investment in the company, how good or how bad the company in their financial performance. Right, now we will discuss that bit by bit. The accounting information may contribute various benefits to make a sound decision. I suggest that various contributions made by the accounting information to management in making the a sound decision are as follows. For example, financial statement analysis, right? So the accounting information, which is the past, we are talking about the balance sheet, income statement, and cash flow statement, is the financial statement. We can use we can analyze that financial statement, and this is maybe run by management accountant to give the management what's going on. And then we may use to make the capital budgeting analysis, or we may use the cost volume profit analysis to make the decision in the future. What is the minimum that requirement of the customers or number of units to produce, and what is the minimum sales unit before we get the profit? That is the break-even point, for example. And then budgeting for planning and control, right? So what it means by budgeting for planning and control means that we can make the budget. Budget is the plan for the year, and then what is the achievement by the end of the year, and then we can see the budget compared to the actual achievement, whether it is below the budget or over the budget. And then basically, when we do it as a control, we can't use the budgeting as the fixed budgeting, but we use the flexible budget for the control purposes. We will talk about that. I'll give you some example of that later on. Right, and then we might go to, if we have discussed about the value change analysis, by using that change, and then we can see whether we are doing that, for example, in the example of a winery company, and then whether we are doing the bottling, or we give it to other suppliers to do that, and we have to make the analysis of that. So we call it as the special decision-making situation, for example. We will discuss more in detail. I'll give you some example of that later. Okay. Now, the financial statement analysis. What is this? The financial statement analysis is the process of analyzing a company's financial statements for decision-making purposes. It may be implemented in various ways. There's a lot of method or technique in the financial statement analysis. For example, we can use the common size statement, which is used to compare the firm financial statement with the previous years or with other companies. That's the common size. Common size is like we have the income statement, how many percent of the cost of goods sold to the sales, how many percent the sales to the revenue, and then that is the common size statement that we are going to use. I think that everyone knows this, how to implement the common size statement, because this is learned in the undergraduate subject of accounting, I think. And then the second is trend analysis. Trend analysis is technique commonly used by financial analysts to assess the entity's gross profit from last year. How much is our sales revenue? How much is our asset? How much is our cash? And then how much is our cost of goods sold? we can see it from years to years, whether it is improved or decrease or increase. If the sales or revenue increases, it's the better. If the cost is increasing, it is worse. But if the cost is decreasing, but the sales is or revenue is remain unchanged, and then it is the better condition. So we can see that from using the trend analysis. And then the third is using differential ratios to answer the questions of, for example, we're using the ratios to analyze the liquidity. Liquidity means that how good is the company, our company, to pay our short-term liability in due time. And using that to ratios using the capital structure. How has the firm financed, whether it is more finance from loan or from the capital. So we can see the capital structure. And then the third is the asset management efficiency, is the measure of how efficient has the firm in managing its assets. So this is the ratios analysis that made by the internal, by management accountant or internal auditors, and then give the information to the management to show them the performance that they have done. And then we can use the that to analyze, to measure the profitability. Means that has the firm earned adequate return or not? And then market value. We have to measure as well the market value. It means that other managers creating value for the shareholders. We can see that market value in terms of the share in the market, go to analyze that from the financial report that is presented in the stock market report, right? So we can see that how much is our stock in the price in the market now, whether if the shareholders is happy with that, and then it means that our share price is going to be increasing in the market, because the better the companies produce the market and the profit, and then the highest, the more the investors would like to buy the shares of our company, the more the demand on our shares, and then the highest the increase of the shares in the market. That's what the market value means. Right. So the fourth is profitability ratios, is to measure the adequate return on its investment, such as using the gross profit margin, using the operating profit margin, net profit margin, return on asset, return on equity, etc., etc. I think that you will learn this in accounting subject, or sometimes it's also been more explored in the subject of finance, right? And then solvency ratios. Solvency ratios is to measure ability of a company to survive over a long period of time, such as debt to asset ratio, time interest earned. And how can we do that? How can we do this analysis? Through the information system. If we know the information system, that we are going to use the gross margin ratio, and then we can put the equation as the software developer, and then take the gross profit from the income statement divided by whatsoever, and then it will be automatically profitability ratios can be presented or produced by the information system. So we know how much the gross margin, how much the profit margin, net profit margin, return on asset, return on equity. This is automatically report to be presented to the management, so they know what is going on or where we stand. So these are some of the information then can be generated by the information system automatically by the computerized system or the software. Right? Are we together? Clear, everyone? Yeah? Okay, so this is about the past. Now let us talk about the capital budgeting. What is the capital budgeting means? Capital budgeting is the process used to evaluate capital expenditure in the rational and systematic way. It can be implemented in several methods, right? We can use the net present value. Net present value is a method to determine whether an entity would be better off investing in a project based on the net amount of discounted cash flow for the project. So then the information, when we do the present value analysis, we need to have the information from the outsider, from the external. For example, if we make an investment, how much is the return that we get every period, every month or every year, and how long will it get the profit? Either we're going to invest that for like say for 10 years, or what is the situation if you want to buy a new machine? And that is that is the net present value analysis. This is talking about the future, right? And then the IRR is the method to determine discount rate necessary to the investment that we are going to plan to do it. So we can use the IRR analysis or method to determine discount rate. A discount rate necessary for net present value of the discounted cash flow to be equal to the investment, and which means the zero. And then we have the payback period as well to measure that. A method to determine the length of time required to recover the cost of an investment from the net cash flow or undiscounted is generated. And then the fourth is the accounting rate of return, or ARR. It's the method that takes the average accounting profit the investment will generate and express it as a percentage of the average investment in the project as measured in accounting term. In real term, these are not independent. This is not just one-to-one, but we have to make it all, and the management will see the payback period. For example, if we do this investment, it can last for 5 years, we can get the investment back, right? And then we can use the IRR. If we use this, then we can find the discount rate. If we use this discount rate, and then we put the analysis using the net present value by using this discount rate, what is the net present value that we can get? And the accounting rate of return as well, we use the financial statement to look at that, the IRR, to take the average accounting profit and investment will generate. And then we can make the prediction and what will be the accounting rate of return if we do the investment for this period of time determined by the payback period. And all of this information has to be available, whether from internal and from external, that we put into database like the one that I showed you in my previous slides. Okay. Now, also another decision making is to use the cost volume profit analysis. Cost volume profit analysis is not already happened. This is talking about the future. This is a management tool that can be used to examine the behavior of total revenue. What is the behavior of the total revenue to total cost and to the profit as the changes occurs in the unit sold, or if we change the selling price, if we change the variable cost per unit or the fixed cost of the product. So this cost volume profit analysis, basically, we use the information that available, the information about the revenue, the total, the cost per unit, and the unit sold and the selling price, existing selling price. We can put the scenario. So we can have the scenario, what if we change the selling price? What if we change the variable cost? What will we change the fixed cost? What will we change if they change the selling price to increase or decrease? What will be our profit looks like, right? So this is put the scenario. If we change to this mark, this is going to be the profit. If you change this, this is going to be the profit. And the management can see the scenario and they will make the best scenario and to choose the best scenario to be implemented. So we can put that as a direction, as the strategy towards as the plan to do in the near future. Right? Then we will see it is important to have the prior understanding on the concept of fixed and variable cost. You have to be able to understand about the contribution margin and contribution margin ratio. This idea commonly implemented in the specific assumptions that is applied to an analysis. They call it the break-even point analysis. So once we know the variable cost, we can set it up from the existing system. How much is the variable cost of the company in making those products? If you want to make a new product, how much the variable cost of that? And then how much the expected selling price? And then we can determine contribution margin. And this can be set it up in the information system that can easily play by the management, and they can see what kind of decision and the options that they can do to make a better profit for the company. Right. So this tool is effective to guide the management to make a decision for product cost, to make a decision on sales price, to make a plan for targeted profit. Right. And the break-even point is the sales volume at which revenues and total costs are equal, so no profit and or loss is made. So this is the bottom line. This is the very minimum situation in which we don't have profit and no loss, right? Now, the formula to get the break-even point, we can use the fixed cost divided by contribution margin per unit. Right. Now, let us see. Now, if we are using the textbook, like you are in the class, probably you will be given how much the variable cost, how much is the fixed cost given. But in reality, this fixed cost is a huge of item, can be hundreds of items. And you can't, it's not easy for you to do it one by one. But if you are using that in the information system, that this cost will be fixed, this cost is variable, and you already categorize that, the software developer can make that in the total fixed cost can be automatically created by the system. So you know how much the fixed cost. And the same with the variable cost. Variable cost in the production manufacturing firm can be hundreds of items. And then these hundreds of items will be categorized into variable cost, and then it will be created by the system, can be given to you, and then you can make that to make the break-even point analysis or cost volume profit analysis. And then we can discuss that to management, whether we need that information or not, what kind of information that they want. And then we can create the scenario about the option to be done, whether to reduce the selling price or to reduce the variable cost, and how to reduce the fixed cost. If we reduce the fixed cost by cutting the activities, let's say the non-value added activities, which is the fixed cost, and then what is our figures of profit looks like. Okay. Now, I give you some example of this. For example, this is an example that I make. For example, a puskesmas in Malang region received a budget from Pemda, from the local government. For example, this is a puskesmas. Yeah, we're talking about. I'm talking about the clinic, right? A puskesmas is a clinic in Malang region. Receive a budget from the local government, 460,000 a year, for example. And the fixed cost of the puskesmas, which is to pay the doctors, the nurse, and the rental of the building, electricity, and so forth, they are 235. That is the cost that has to be paid by the clinic or the puskesmas. The average variable cost, for example, per patient visit is expected $7.67. This is, for example, this is the cost to treat in average patients. While the BPJS, which is the health insurance that paid to each patient according to the government regulations, for example, per patient visit is only $4.67. By doing this, how many patients that need to be getting by this clinic in Malang to make it break even, right? By having this information has to be provided by the information system, whether from external or internal, whether from the estimations or not. And we use that to create and to make the cost volume profit analysis by measuring using the break-even point. Like I mentioned before in the beginning, break-even point will be 0 if the contribution margin per unit times number of patients plus the budget minus fixed cost is 0. That will be the break-even point. Now, the contribution margin per patient will be $3, which is $4.67. We get it from the BPJS minus the $7 that the cost of the patient. So we get here contribution margin is minus because the revenue is smaller than the cost. So we get that minus $3, while fixed cost is 235,000. Now, how much is the break-even point? When we do the break-even point, so 0 equal minus 3 times number of patients plus $460,000, which is, this is the budget from PEMDA, and minus 235. When we use this, then we can know the 3 plus 225, then the tree number of patients is 225,000, and then number of patients to get it break even is 775,000 per number of patients per year. If we get the patient less than 75,000, then there will be a loss. We can't pay all of these fixed costs and variable costs. Are we together? Right? This is an example of the break-even point. So let us prove. If we get 75,000 patients, and in which the cost of that is 7.67 per patient, 7.67 times 75,000 patients equal to 572,250, and then fixed cost 235, total cost is at 110. And then we can see here, right? So BPJS paid 4.67 times 75,000. This is the income that we receive from BPJS, and therefore the grant from PEMDA will be 870,000, 810, 250 minus 350,260 equal to 460,000, which is equal to the budget that we received from PEMDA to cover it up. So it makes it 0. Okay, now let us see, we use that analysis in the different way. If we are talking about how much is the budget that we need, for example, we have the same situation, fixed cost is 235 and cost per patient is 7.6, average collections from the BPJS is 467.67, and average patient per year is 75 patients. How much the budget we required from the PEMDA? So we use that to get break even. So we use the formula again, and then we can get here and the break even point, get that, and then we get here X will be, the budget we'll need is 460. So it's the same as that. So we can use from the backward or work forward or backward. All right. So here, if you want to know how much is the budget, if you change the situations, for example, the patients in average is 50,000, for example, change that in this formula, and then you can get the budget that you need from the government. If the patients is increasing to becomes, in average, we get like 100 patients, and then how much the need of the budget minimum that we need to have. This, all of the information is required to be available from the information system so we can do this analysis. Are we together, everyone? Right. Now, I will talk about budgeting. What is budgeting? Budgeting is the budget, the implementations of the budget is a budget, the product of the budget is a budgeting. Budgeting is a process to do that, right? So a budget is a quantitative expression of a proposed plan for a specified period. A budget is an aid to coordinate implementations of the plan, which may include financial and non-financial data. Right. Your budget is a blueprint for the company to follow. This is like the path, right, of the company's activities. So budgeting is a process to prepare the budget. The budget is the product, and budgeting is the process. A budget has two distinct purposes. As for the budget can be as a plan, which involves developing the goals and preparing various budget to activity those goals. So budget is the planning in the monetary terms. So the budget is the activity that the company will do, and then the cost of that activity in terms of money, that is the planning in terms of money, that is, we call it as a budget. And the controls involve the step taken by the management to increase the likelihood that all part of the organizations are working to achieve this goal set down at the planning stage. Right. So budgets help manager to communicate the directions of goals and judge the performance by measuring result against planned goals and learn about potential problems. So motivate employees to achieve that goal. So they have the budget. This is your sales budget. So the marketing people will know how much is the sale that they have to do to achieve this budget. So this will motivate them to do. Then budget also promote the coordinations and communication among subunits. For example, if we are going to do the sales, for example, the budget, developing the budget, starting with the sales budget. When they make the estimation, how many unit of the sales that have to be sold for the following or next year, and then they set up the sales budget, how much the selling price of the sales budget, browsing down, and then we know how much it is sales budget. And then once we get the sales budget, this sales budget has to be supported by the manufacturing budget. How many units the manufacturing or the production unit need to produce the product. So this will be the coordination between the sales department with the productions department. And the production will make the productions budget, how many units that they're going to produce. When they has set up the productions budget, and then this will be coordinated with the purchasing department. The purchasing department have to set up the purchase budget of the material regarding their productions budget. And then they communicate one to another to achieve that. And this of the budget has to be run in the meeting, which is the budget meeting, right? And the budget provide a framework for judging performance. And also the budget will motivate the managers and other employees, of course. And coordination is the meshing and balancing all aspects of productions or service and all departments in a company is the best way for the company to meet its goal. Now, communication is also important in this because this is one of the role of the budget, making sure that those goals are understood by all employees. So they know what is the goals, what they need to achieve, what is the limit, what is the budget. Right. Framework for judging performance and facilitating learning. Budgets enable measurement of actual performance against predicted performance. So budget is the predictions. The budget is the future. But it is also the budget must be prepared in the information system. So people know what are everyone's budget. And then the budget can be used from the information system, can be compared to the achievement, to the actual achievement, and then to measure their performance. However, once that we need to understand, there are two limitations of the budget, right? And they are the past result sometimes is miscues and substandard performance. They are not the situations in when we set up the budget. It's not the same assumption that happened actually occurred when the company or the employees all doing the implementations of the actions or what they're doing or their productions or their selling, right? The actual activities, the result of the year, the actual result. Maybe the assumption is different to the budget assumptions in the past. And also the future condition can be expected different from the past. So this make the limitations of the budget. We can't just believe that the budget is the actual performance must be equal to the budget because it will never the same. But we need to analyze that, whether the difference will be acceptable to make the result is different from actual result and the budget. We will talk about that. So the budget also motivating managers and other employees by challenging budget, improve employee performance, and these are important. Now, we are going to more in detail about how to measure the performance. Flexible budget and control. Flexible budget and control. When we set up the budget at the beginning of the year, we call that budget as a static budget or master budget. Master budget is based on the level of output planned or estimated at the start of the budget period before the actual sales or the actual activities are known. So this is the estimated right? In the one situation estimated for the future before the action is done, right? This is what we call as static budget. Now, the master budget. Master budget is called as a static budget because it is developed around a single or static plan output level and the standard cost found in the standard cost sheet. So we use the standard cost, we use the plan output, and then we use the standard cost to determine the standard master budget. So if we compare the static budget with the actual performance, which is we call it a static budget variance, it will show the difference between actual result and the corresponding static budget amount. Is that correct? Not always. We will talk about that. Now, favorable. So the variance means the difference between the budget and the actual achievement. This is when we compare that, we can see the difference, whether the difference has the effect of increase the operating income or decrease of the operating income. That is what we call as a favorable variance. Favorable variance is the effect or the difference of that increasing the operating income relative to the budget amount. While the difference may be unfavorable as well, we call it unfavorable variance, has the effect of decreasing operating income relative to the budget amount. Now, when we look at that, because we agree that the assumptions of the period of the budget period, when it assumes that when the actual assumption, the actual situations happen, will be different, and then what makes the flexible budget is needed. Flexible budget is the budget that is flexible to measure the performance. Now let us see. Hang on. Okay. This is for example of the static budget variances. For example, units sold 10,000 and static budget according to the budget is 12,000 they have to achieve. So it means that there is a variance. The activity actual result not achieve the budget by below the budget by 2,000 units. So this 2,000 unit is less than the budget. We call it as unfavorable variance. That's why I put the notated here. U is unfavorable, F is favorable variance. So the actual result revenue is 1,250,000 and static budget variance, the static budget is the expected budget, the expected achievement has to be sales is 1,440,000. So by comparing this to that, we get the static budget variance is 190,000 unfavorable. It means that revenues in terms of dollars is lower than static budget revenues. Of course, they will be different. Why? Because the units sold is different. Of course, it becomes the revenue is different. That's why this static budget variance is not really important or reasonable. And the same things with the cloth. For example, direct material is such and such and such, direct labor cutting, or these are the costs. This cost is for the unit $10,000. Oh, sorry, 10,000 units. While the static budget show these are the budget of the cost for $12,000. Of course, this is going to be different. But you can see the clothes is still have the favorable variance. The clothes cost is less than static budget by 104,525. But actually the favorable is not that much. It's much be greater than that because the unit sold is less than 12,000, which is 2,000 unit less. Now let us see how are we going to that. To do this, to analyze this, we need to compare the actual result, not to the static budget, but to the flexible budget. Right. Now let us see. Static budget are prepared for a single planned level of activity. Performance evaluation is difficult when actual activity differs from the planned level of activity. It means that we compare static budget, planning budget with actual cost. It's like comparing apple to bananas because they are different situations, 10,000 and 12,000. So that's why we need to set up a flexible budget. A flexible budget calculates budgeted revenue and budgeted cost based on the actual output for the period. It uses the expected per unit price cost found in the standard cost sheet multiplied by the actual unit activity. So the only difference to the static budget is that it's based on actual sales volume. What does this mean to you in terms of accounting information? In the accounting information, we have to have the standard cost, variable cost, and fixed cost. That the standard cost sheet has to be available in your database information system, so you can easily take it out and put into your analysis. You can easily take it out to prepare the flexible budget and then compare that to the actual achievement. Now, let us see here, for example. This is the actual result for the 10,000 unit, right? Like in the previous slide. So we need to modify the budget. This is the static budget. This is for the 12,000. At the beginning, we're using the static budget by compare this, which is inappropriate. So we need to create one other budget, which is, we call it static budget. How much is supposed to be the budget if the unit sold not 12,000, but 10,000? We use the standard cost or standard price to do that. By doing this, the flexible budget for 10,000 units, we only supposed to get the revenue, not 1,440, but only 1,200,000. So it means that the actual result of the revenue is greater than flexible budget. So it means that their performance is good because better than our budget. But don't use the static budget because the static budget is for 12,000, not for the same 10,000 units. How do I know this? I use the standard price multiplied by 10,000 units, so I got 1,200,000. So I do the same thing, the standard cost for each unit, standard cost for clothes, zippers, cutting, sewing, and all of this. Then I can see the flexible budget. Now I can compare the actual result with the flexible budget. Then I can see flexible budget variance. When I compare here to that, then I get 0. Revenue, it is better 550,000. And clothes, compare this to that, the cloth is 580, while the actual is greater than that. So it means that this is unfavorable and this is favorable. All the cost is unfavorable, right? And then we can use the flexible budget compared to the static budget by having the sales volume variance, which is the impact of this 2,000 unit. So we can see here that now, right? So that is the flexible budget, and we can show that variance analysis of using the flexible budget for control purposes to measure the performance. Okay, now, having done that, hang on, right. Another situation that I would like to say, that is, there are 4 special decision-making situations that I would like to discuss. Like in the previous slide that I've discussed, that in each step, we like the value change analysis, we can see the activities. We use the cost-benefit analysis, whether we want to do the bottling or not. If not, then we can outsourcing that to the other companies to do that, right? So there are a couple of situations that may come in the activity of a company. One is the special order. Special order is one type of decision that affect output level in accepting or rejecting special order when there is idle production capacity, and special order have no long-run implications. So in the special order analysis, we have to make the how much if we are making it ourselves, how much if we also receive the for example, there is a customer would like to purchase our product, right? If they want to buy the product, but they said that hey, this is a special order, I can buy quite a big numbers of units, but can you give me a special price? And then we will see how much do you want, and then we try to analyze that. If we agree to that, and then we will, okay, sign up the contract. What is the importance of that? The importance of the special order. Special orders, usually the special orders only consume variable cost because the fixed cost is already fixed. Whether we accept the special order or not, fixed cost must be paid. So we have to, as a management accountant, we use the information, we use the variable cost, we use the sales, the purchase price for the special order, and then we can compare cost of benefit analysis, which one is better. If it is the profit is increasing if we accept the special order, then the special order will be accepted. If not, then it will be rejected. Right. And then another situation is product line or business segment, to keep or drop a unit or a product or the store. And these are the example. These are some of the situations, the special decision making. Of course, the management accountant must make the decision of cost benefit analysis as well. And also using the make or buy decision, in-source or outsource decision, like the one that we have discussed in the value change analysis. And then constrained resources. For example, we make an analysis if we buy a new machine or make the process, whether we change the process, because if we continue doing this, then we get the lock up the activities in this by relying on only one machine. So we need to buy a new machine, but what is going on? We need that or not? And then will be the decision as well using the cost benefit analysis. I think there's all of the items that I would like to discuss in the second session here. And I would like to offer, is there any questions?
Okay, ladies and gentlemen, the insight we got from Mr. Parulian Silaen was extraordinary. Next, I will open the opportunity for the audience who wants to ask question. Nanti pertanyaannya bisa disampaikan dengan bahasa Indonesia ataupun bahasa Inggris. Oke, does anyone have any question?
Anne.
Yeah.
How are you, Anne? I love you asking questions.
Thank you.
All good, all good.
Your material is a bit more good. And that's
Thank
why
you.
I'd like to ask, like if you said when the company is on break-even point, what the contribution of accounting information to that company? What would be the contribution of management accounting information when the company is on break-even point?
Okay, right. The break-even point or cost volume profit analysis is an analysis. Usually this analysis is run or do by management accountants. This is not the management job. This is the management accountant or internal auditors to do this analysis. The result of the analysis will be communicated, conveyed, tell the managers, this is the situations that we're dealing with. So the managers know, for example, in the case of break-even point, the managers know, all right, so this is the minimum unit that we need to sell. If we sell less than that, then we are in the big trouble. But to analyze the break-even point or cost volume analysis, we need to gather many information. We need to find out how much is the sales price in average that we sell to various customers. How much is the production cost? What is the characteristic of the cost? How much the variable cost? How much the fixed cost? So we need to know that. This information must be facilitated by the accounting information system from the database. So we can do that analysis. Does it make sense, Anne?
Yes.
Okay.
Also, another one concerning to the cost volume profit. How could you determine more? Could you provide more detail on how cost profit analysis can be authorized to you to make pricing and production decisions? Maybe you can use.
Yeah. That is pretty easy, right? So if we, for example, the cost volume profit analysis is that is the analysis using the relationship with the cost, volume, and profit, right? So that is the concept. The implementations of this concept is break-even point analysis. Does it make sense?
Yes.
Right. So we can use the break-even point analysis. By using that analysis, we know how much the sales price, we know how much the variable cost, we know how much the fixed cost, and then we know how much is the unit that need to be sold, for example, okay? Then what happens if the management can put the scenario? What happens if our competitors in the market, their price is lower than us? If we continue doing this by selling the same price, we are dead. because we can't compete with them.
Yes.
The customers will go to our competitors. And then management need to make the scenario. What if I reduce the sales price? If I reduce the sales price from $10 a unit, for example, I reduce to $8 per unit. What is going on? How many units that I have to sell minimum to get it break even? Because usually the marketing people will say, if we reduce the sales price, of course, a lot of customers will buy. That will impact to the increase of the units sold. Will it be better or not? That is the analysis that we make as management accountant. If we can make the innovation, for example, go talking to the productions unit, if we can reduce the variable cost this much, it will make our break-even point will be lower. And then it will make our sales price, we can sell it lower, but we can get the same profit or margin per unit. Does it make sense?
Yes.
Okay, great. Great.
Thank you.
Thank you for your questions, and Mary. Very interesting. Okay, that's all right.
Okay, maybe more question.
Yes. We need more question. Come on. Tanya.
Iya,
Bahasa
teman-teman bisa.
in Indonesia, bahasa Indonesia, no problem. I
Iya.
can speak both bahasa. I can speak 3-4 languages.
Izin bertanya Kak Tiani.
Ya.
Baik, silakan Mbak Widiana Rahma.
Baik, hello, my name is Widiana Rahma. I would like to ask a question regarding the risks in financial statements. My question is, does excessive reliance on accounting information for business decision-making carry significant risks? Yeah, as we know, financial statements can sometimes be biased due to manipulation effort by management. And then my second question is, what aspects should be considered to ensure decision makers do not misjudge due to biases in financial statement information? Thank you.
Okay, all right. One thing is right. If you're talking about the financial statement information, that has to be prepared by the accountant, right? And then we assume that the accountant will do that, will prepare the information according to the standard and correctly, and all of the evidence must be validated and correct and true. That is one. The only thing that your questions is whether the management will manipulate that. Basically, the information is there. The management cannot manipulate the information because the information, if we do it automatically or by the computerized system, the management cannot change that because they are integrated one to another. The information is there. The question is now, is the analysis. The analysis must be analyzed by the management accountant, not the management. So the analysis is make the report the report is made by the management accountant by saying that this is the one that you asked me. I analyzed that from the data that we have from financial information. This is the result of the ratio, blah, 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 of the ratio. The management, if the management want to manipulate that, the evidence of the management accountant report is there to prove that management is manipulate the interpretation of the result. But anyway, what for? Because they can't manipulate that. The outsider will analyze the information that they get from the financial statement published in the stock exchange website. So that the analysis will be made by outsider. But if the manager want to manipulate it to their boss need to have a meeting. In the meeting of the result, they have to present the management accountant there, standing toward the result of the analysis and describe that to everyone. Did I answer your questions, Anne?
Yes, it's very clear. Thank you.
Yeah, and also be aware, as a management accountant, we are bound, the ikat of by the ethical and moral. As a member of certified management accountant, we have the ethical bounding that we have to do it ethically and according to the rule and regulations. Is it clear, Anne?
Yes, thank you.
Thank you very much. Anne-Marie, do you still raise the questions?
Another one, my last question. Can you explain
Not only last, because the second last, the third last is all right.
Oh, thank you. Can you explain the relationship between cost management and value creation in an organization, and how management accounting technique can be used to identify and eliminate non-value adding activities?
Sorry. Can you repeat the question? Sorry.
How management accounting techniques can be used to identify and eliminate non-value adding activities.
Okay. Right. All right. Thank you, Anne, for the questions. Right. If you look at the value change analysis, yeah. So every activity, or you can use the activity-based costing, for example. Activity-based costing, we can see each activity. Every activity will have the cost. How much is the cost of every activity? Then we will sit down, take all of the activity and the cost of each activity, bring that, take the data from the accounting information system, right? This is the cost of this activity. This is the cost of each of the activity. And these are the benefit of this activity, the revenue that they created. And we show them to everyone. Then in the meeting, we will ask them, not us, not the management accountant, but we ask the management from every department. For example, we can ask them by saying that, look, is there any activity here that you think we can eliminate? For example, in the productions department, the people taking the raw material from the warehouse go to the loop of the machine. It takes 10 minutes, for example. Is there anything we can do this? And then the productions department manager says that, oh, yes, we can. We can put the warehouse closer to the loop of the machine. So it will not take 10 minutes. It will take only 1 minute to take the shovel loader and bring the material put into the machine. By saving 9 minutes, right, the activity will decrease from 10 to 9 minutes. For example, the cost of 9 minutes per loop to put the material every day, for example, 100 times, if we save 9 minutes times 100, 900 minutes per day have already been saved. 900 minutes per day times 5 days a week times how many days a year, that is the save of the cost. So we can eliminate the activities that not contributed activities. And for example, again, when we want to get the material, before the material is allowed to make, we have to get the signature from the warehouse department. But the warehouse department sometimes have a break and this and that it takes a bit longer to get an approval before the material can be used and put it into the machine. And then the production department have to make and wait to the approval. So do we need to get the approval from them or not? If not, then tuck it out and then we save the time. Does it make sense?
Yes.
Okay. Thank you, Anne.
Yeah, welcome.
Okay.
What a great answer from Mr. Parulian Silaen. And then, apakah ada pertanyaan lain dari teman-teman? Boleh bertanya pakai bahasa Indonesia ataupun bahasa Inggris, silakan.
Boleh. Silakan.
Silakan langsung raise hand atau bisa via chat di kolom komentar.
Saya ingin bertanya.
Ya, silakan.
Boleh menyampaikan dengan bahasa Indonesia?
Boleh. Saya orang Indonesia kok. Okay.
Perkenalkan, nama saya Diara Gilsa Putri. Saya ingin bertanya berkaitan dengan topik decision making, di mana saat ini tuh terdapat software yang bernama Fuzzy Logic. Nah, software ini biasa digunakan untuk sebuah pengambilan keputusan. Yang ingin saya tanyakan adalah, apakah Bapak pernah menggunakan software ini untuk penggunaan di bidang akuntansi, dan apakah oke jika penggunaan AI untuk sebuah pengambilan keputusan di bidang akuntansi?
Oke. Ya, saya kira
Terima kasih.
Saya jawab ya. Saya kira bentar dulu dia minta confirm. Saya kira saya belum pernah lihat software itu, tapi yang saya tahu AI itu memang baik ya untuk membantu sedikit, tetapi itu sangat berbahaya. Karena AI dalam membuat keputusan, dia kalau ingat, waktu membuat keputusan kita based on information. Nah, informasi yang ada, informasi itu sekarang itu, informasi itu sudah cepat sekali berubah. Informasi hari ini, hasilnya hari ini, harga bensin hari ini sudah berubah dengan besok. Cuaca hari ini menyebabkan jalanan macet atau tidak macet sudah berubah untuk besok. Sehingga kecepatan truk membawa bahan material yang tadinya cuma nyampe 5 jam sudah nyampe, sekarang bisa sampai 8 jam. Berhubung karena kondisi, asumsi, latar belakang, dan segala aspek itu akan mempengaruhi kondisi informasi itu, yang saya percaya AI menggunakan informasi yang ada di database-nya itu mungkin sekitar 10 tahun belakangan. Dia nggak punya data informasi yang tahun lalu atau 2 tahun yang lalu atau 3 tahun yang lalu. Sehingga kalau kita membuat keputusan berdasarkan informasi mereka yang sudah outdated, maka mungkin kita akan membuat keputusan yang salah. Di situ sebenarnya yang kita perlukan adalah manajemen yang pinter, smart, dan inovatif. Dia harus menguasai pekerjaannya daripada dia ngambil dari data-data cuman dari AI. Kayak contoh misalnya. Sekarang contoh ini, maaf nih saya bawa contoh yang realita ya. Sekarang kalau kita lihat harga beras sekarang di Indonesia misalnya sudah hampir 2-3 kali lipat dari harga beras tahun lalu. Itu. Harga listrik, biaya listrik sebelum perang Rusia-Ukraina terjadi itu harga listrik masih lebih murah. Sekarang sudah meningkat jauh lebih mahal. Kenapa? Karena terjadi perang di sana. Apa hubungannya perang di sana dengan listrik di Indonesia? Ya ada, karena Indonesia perlu bensin. Bensin nggak bisa lagi diambil dari Timur Tengah. Dia datangnya lambat, harganya tinggi. Kalau kita ambil data sebelum perang Ukraina dan Rusia, maka data decision kita akan salah. Gitu ceritanya misalnya. Terus sekarang misalnya katakanlah terjadi perang Palestina dengan Israel. Apa yang terjadi? Kawasan itu tidak aman. Sehingga perjalanan kapal pun akan menjadi lambat. Harga transport barang akan naik. Sehingga kita terpengaruh di sini. Kita nggak tahu lagi kejadian. Baru kemarin pagi Presiden Iran meninggal dunia, terjadi kecelakaan. Apa yang terjadi di sana? Iran itu adalah pensuplai minyak sepertiga dunia. Efeknya ke kita apa? Mungkin itu belum terdata di dalam data informasi yang ada di AI. Jadi kalau kita gunakan itu, ya sudah enggak. Makanya kita perlu yang up to date informasinya. Does it make sense? Kira-kira saya jawab pertanyaannya?
Yes, thank you, sir.
Oke, dia. Oke, nggak apa-apa. Silakan.
Oke, baik.
Si N mungkin pasti mau dia kah atau kenapa dia raise hand tuh?
Oh
Do
ya,
you still have any questions, N?
Yeah, so many,
Okay,
but
it's okay. It's all right. Don't worry. Don't feel bad.
yeah. My question is, how does flexible budget improve performance evaluation compared to a static budget?
Okay. So, thank you for your question. Right. The static budget is basically, some people, they don't understand. If they don't understand the flexible budget, they use the static budget as a comparison to measure the performance. While according to this logic that I have explained, it looks like using the static budget variance is inappropriate. It looks like you compare apple to bananas, like I said, because they are two different things. Your budget is 12,000, while your actual is talking about 10,000. So you compare the 12,000 and 10,000. The cost to make 12,000 and 10,000, of course, they are different. The sales price, the sales of the 12,000 and 10,000 is different. Of course, the sales revenue will going to be different. Why do you compare that? If you compare that, it's going to be inappropriate. So that is why we're resetting that by using the flexible budget. Flexible budget, we create the budget just for the purpose of comparison, just for the purpose for measuring the performance, right? So we set up the budget based on the actual unit. So we can compare 10,000 to 10,000. And then it will challenge. Then we can see it, we can tell to people, say, look, if we are using this 10,000, look at the standard here for 10,000, I got this, and then you get that. So it means that your cost is higher than it's supposed to be. So you need to make an improvement next time. If we do it every month, and then we can ask them to do it for the next month to make it better. Until the end, our company will be making better for 12 months period of time. Does it make sense, Anne?
Yes.
Okay.
Thank you.
That's all right.
Yeah.
baik. Mungkin ada lagi yang ingin bertanya.
Gimana diskusi kita? Menarik atau?
Sangat menarik. Yes, sir.
Terima kasih.
Teman bisa bertanya dengan bahasa Indonesia atau bahasa Inggris. Silakan para hadirin untuk raise hand atau via chat terbuka.
Nah, si N tanya lagi tuh. Hai
Boleh
N.
silakan.
Maybe for now, my question is
It's okay.
no, for now, I'm still thinking.
Sorry?
I'm still thinking about the question. Maybe the other they can ask. Yeah.
Okay. Anybody else?
So for another question, like you said, actual budget and static budget. So what will happen, or what can a person or organization do if maybe you plan like you have 10,000, maybe you see it's more than, maybe the amount you have is not enough. So what can you do, or organization can do?
Okay. Look, we have to put it in the different way. Okay. So we are talking about two things.
Yeah.
One, we are talking about planning, and another one is control.
Yeah.
Right? So the budget for planning and control. So budget for planning is the static budget. So we make the budget, like for example, in December this year, to be run, to be done, to be executed January next year.
Yeah.
So that is the static budget. So the purpose of static budget is to make the plan, to give the direction, to lead the activities, what to do in the future. For example, we get the sales budget. Sales budget is 12,000 units, for example, with the price of $12 a unit, what 1,200 of a unit.
Yeah.
And then we create, to make 12,000, we need to make the production's budget, how much the variable cost to make 12,000, or we need 1 kilogram material. We need the people to work 20 hours per unit, blah, 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 blah. We put it in detail. That is the budget for 12,000. And then we set up the static budget for 12,000 of all the costs. So we get the static budget that is for the direction. So next year, we plan to make 12,000. We plan to sell 12,000. But the marketing people, the sales people, actually, they couldn't make it. They're only able to sell it 12,000. If they only, 10,000, if they're only able to 10,000, and then how much is the cost of 12,000 is supposed to be? That is another purpose in which we have to use not the static budget to determine that, but we use not a new budget, they call it as a flexible budget. So the purpose of flexible budget is to measure the performance, not as a plan for the action.
Yeah.
Does it make sense?
Yes. No, I get it.
Okay, great.
Thank you so much.
Okay. Thank you, Anne.
Okay, maybe I think that will be the question from Anne. This question is the last question as well as closing the discussion this time. And then to close the question and answer section, we ask Mr. Parulian Silaen to give his closing statement. The time is yours, Mr.
Okay. All right. One thing I would like to say, thank you very much for everyone that attending this meeting. I really enjoying giving my presentation to you all. I'm really enjoying having the question from you. But another thing, my closing statement is, as an accounting student, I would like to inform you that there's a lot of things that we need to do. One thing, because the market is so competitive, and then I found that there is a need, a really need about the professional and the technical knowledge of an accountant. So please do that, adapt that situation, improve yourself to get that professional and technical proficiencies or ability so you are able to work in the market. For example, the software, at least that Excel software is important for you to know that as a beginning. Microsoft Excel is important. I did a bit of a survey and research here, and I found that a lot of the companies that would like to accept the first year graduate, the fresh graduate from accounting, they need to know the very basic software, not always the accounting software, because you can learn that later in the company. The company will train you what to do. But you need to know some basic things like the Excel software. How are you going to do that? Especially for management accountant, the Excel software is very important to create the scenario, like break-even point and budgeting, performance, flexible budget. They're all you can play around with the Excel, taking the data, whatever, we can make the assumption, and then you can create that to help the management in making a good decision. That is my close statement, and I hope that everyone enjoy this meeting. I hope that you are having the best of in your future as an accountant. I'm very proud of you. Thank you. Thank you very much.
Thank you very much, Mr. Parulian Silaen, for delivering the material, discussing, answering question, and delivering your closing statement. Okay, ladies and gentlemen, before we get to the end of the event, here are some things we can conclude, namely, accounting information can provide various benefits for decision-making, including financial report analysis, capital budgeting, cost volume profit analysis, budgeting for planning and control, flexible budgets for control purposes, and special decision-making situation. Ladies and gentlemen, it doesn't feel like we have reached the end of the event. I would like to express my gratitude and my highest appreciation to our speaker who have shared their knowledge. Then I also appreciate the entire audience that attended. Don't forget to also say thank you to all participants of this event. Nah, sebelum saya tutup acara ini, saya punya pantun sedikit ya.
Okay.
Siang hari makan kuaci nih. Makanya bareng sama hadirin terkasih. Cukup sekian acara hari ini, saya ucapkan banyak terima kasih. Diana Rosati. Diana Rosati on behalf of the event organizer. Apologies if there were any lags or error during the event process. I excuse myself for leaving. Thank you for your attention. Wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam. Thank you very much.
Terima kasih, Pak Uli.
Yo, Mbak Heli. Thank you.
Sampai ketemu lagi nanti di acara lainnya, Pak Uli.
Okay, thank you.
Yeah.
Thank you. Okay, bye everyone.
Bye.
Bye.
Bye.